Ladies and gentlemen, what is good? Today I want to talk about inflation and interest rates and how they impact the economy. So, I feel like this is an important topic to discuss right now because of what we're going through as a world, really, with the coronavirus pandemic. Obviously, with businesses shutting down and people losing work, it's had a large impact on the economy worldwide. So, there's been a lot of concern about where governments are going to go and how we're going to rebuild our economies worldwide. And at least in the United States, we've seen recently some action. So going back a few months ago when everything was shut down, the Federal Reserve, which is the central banking system for the United States, they control a lot of the not necessarily monetary policy, but they will control basically economic stimulation. So they'll do a lot of things to make sure the economy is going in a positive direction, and they will take action with whatever they feel is necessary to get that in a good place. So what they did back then, a few months ago, was drop interest rates, and on its face, it's pretty easy to understand what that means. So you take a loan, whether it's for a mortgage or a car, student loans, and you have an interest rate that you have to pay back. So, let's say you take $100 loan, you get a 5% interest rate, you have to pay them $105 back. So, this there's a lot to interest rates aside from just that. So, interest rates are directly tied to inflation, and I don't think a lot of people understand that, which is really the main reason I want to talk about this. So, before talking about that direct tie, let's talk about exactly what inflation is. So, inflation is defined as when the supply of money exceeds the demand for money. So, basically, this means that the government is putting out more money into the economy than is being spent. So, this devalues the dollar. So, most people know inflation. You think about back in 1930, a gallon of gas cost 25 cents, and now it costs around $2. That's because of inflation. We've injected more and more money into the economy over the past 90 years, so the dollar over time becomes less and less valuable, which is why prices rise. So inflation is good for the growth of the economy because essentially your dollar today is worth more than it would be tomorrow. So if you buy something now, then you're going to get a better deal because the prices are going to rise. So if you go out and buy, a car for $20,000, instead of waiting, a couple years from now with inflation, you're going to technically be saving money because the value of the dollar is worth more right now. So instead of spending, $20,000 or whatever, you're going to be spending only $20,000. So not that that's exactly the direct interest or the inflation rate, but you get the point. So this burns spending because people want a better deal now, so they're going to be more likely to spend money now instead of later. And the opposite of inflation is deflation, where prices get lower. And why spend money now if you know that you're going to be able to save money by waiting later? So inflation is good for the economy, and governments and the Federal Reserve want inflation so people don't just sit on their money, and money continues to flow throughout the country. So we have seen in 2020 we're at the lowest point of inflation we've been at since 2015. So the Federal Reserve wants inflation to go up. And obviously, a big reason of that is because we've been in a recession. So we want more spending. So, there's more money moving out there and the economy grows. So the Fed wants inflation. And they have set a goal of 2% inflation, which is a little bit, it's about 0.7% above where we're at right now for for 2020. So they have set a 2% inflation goal for the next few years. And to ensure that this is going to happen, they have lowered interest rates to near zero rates. So another way for economic growth is for people to take loans, because most of the time loans equate to some sort of growth opportunity, whether it's taking a loan for a mortgage or student loans, or like a small business taking a loan to grow their business. These are all good things for the economy because, people are spending money and, either getting an asset like a house or developing themselves in a way to get a better job. So there's a lot benefit of loans. And it's great to get a low interest rate loan during a time of inflation because the money you're borrowing now is going to be devalued over time because of inflation. So it's also, so not only is it a good time to get loans because of the low interest rate, it's also a good time to pay off loans because the money you have now is going to be worth less than the money you borrowed. So it's a really good thing, and that's why interest rates and inflation are tied together. During times of really high inflation, to essentially slow down the growth of the economy, a government will set very high interest rates, so there's not going to be as much spending. And when there's less spending, that inflation comes down. And I think it was back in the 80s, like 82, 83, we had a period of 19% inflation or 14. It was in the teens somewhere. And just to match that, the Fed dropped a interest rate in that similar range as well. So that helps balance it out, and that helps bring inflation down. So inflation is good, especially for an economy that we're in right now where you want it to grow. We're in a recession, we're trying to come out of it. And so inflation is good, but you also don't want it to go too far above 2%, which is what the Fed is aiming at for the next few years. So the reason you don't want it to go much higher than 2% is because you want the wages to match it. Because if otherwise people are going to be spending too much of their money, they're going to be spending too much of their earnings. So if you have a 5% inflation rate and a 2% wage increase, then you're only, you're spending more money than you're making essentially. And you don't want that. You want there to either be a higher raise in wages, or you want them to be pretty close and match. So if you have it too high either way, it's not going to be good. But 2 points of inflation, you don't want it to be too high. You don't want it to be too low either. That 2% range is perfect because it pretty much matches up exactly with the rate of wage growth for the most part. So the Fed they have said that if their inflation goal doesn't reach 2% for an extended period of time, they would like to see it above 2% for an extended period of time. So, and they also have committed to keeping the low interest rates. So it's going to be interesting to see if that inflation actually ends up going far above 2% at all. And if it does stay above 2%, how long it takes for them to lower the interest rates, or up the interest rates back to a point where you can balance things out. So that's basically it. It's kind of a tough topic to understand, and if you don't feel like I explained it perfectly, because I do feel like I was kind of rambling at points, but I am going to link an article I wrote on this. And most of these videos I'm talking about stuff like this with the economy and business. I most of the time do have an article I already wrote previously about it, and the same goes here. I wrote an article about this yesterday, and I'll put that in the description so you can see everything I talked about laid out. And if you have any questions beyond that, please feel free to comment down below, and I'll see you in the next one.